Unlocking the truth about overdraft fees. A financial reality check. 1. Tackling the overdraft fee dilemma. In recent times, the Consumer Financial Protection Bureau, CFPB, has taken significant steps to address a prevalent financial concern faced by Americans: overdraft fees. These fees, often termed junk fees, encompass late fees, bounced check fees, and overdraft charges, cumulatively amounting to a staggering $30 billion that Americans shell out every year. The CFPB's actions have led to a positive shift in the banking landscape, with a substantial number of major banks scrapping bounced check charges. Furthermore, the overall tally of overdraft fees is on track to decrease by $3 billion in 2022 compared to pre-pandemic levels. 2. Examining a new perspective. In light of these developments, a recent study conducted by Cornerstone Advisors, commissioned by Velocity Solutions, titled Beyond Overdraft, Helping Consumers Manage Liquidity, has raised some interesting questions about whether these changes align with the preferences of the average American banking customer. Often, politicians and critics of the banking industry criticize banks for imposing hidden fees on their customers. 3. Americans' perception of fees. Contrary to this narrative, a surprising revelation emerged from the study. 8 out of 10 Americans, spanning different generations from Gen Z to baby boomers, believe that their primary checking account providers transparently disclose their fees. This challenges the notion that banks are deliberately hiding fee information. Despite the ongoing debate surrounding checking account fees, the majority of Americans, 3/4 of them, perceive the fees charged by their primary checking account providers as fair. This sentiment remains consistent across generations, ranging from 60% among Gen Zers to a substantial 80% among baby boomers. Only a minority, just 27%, find non-sufficient funds, NSF, and overdraft fees unjust, while the rest are uncertain or apathetic. 4. Dispelling the notion of widespread fee discontent. Contrary to the prevailing narrative that suggests widespread discontent with these fees, the survey data reveals a more nuanced reality. It's essential to recognize that the primary challenge faced by Americans is not the fees themselves but their struggle with managing cash flow. In 2021, a significant portion of Gen Z and millennials found themselves in situations where they spent more than the balance available in their checking accounts, with some encountering this challenge multiple times. This situation arises due to various factors, including unexpected major expenses, income shortfalls, excessive spending, and unemployment. 5. Coping mechanisms amid liquidity challenges. In response to these liquidity challenges, Americans employ a variety of tactics, including borrowing from friends and family, incurring late fees by missing bill payments, resorting to payday loans, applying for short-term loans, and even selling personal possessions at pawn shops. It becomes evident that addressing the real problem necessitates a more comprehensive approach than merely targeting junk fees. 6. Identifying the true culprit. The core issues affecting Americans most profoundly are inflation, interest rates, and the overall state of the economy. While recent changes in overdraft policies by financial institutions may appear favorable to consumers and align with regulatory and public relations objectives, they pose a significant revenue challenge for these institutions. Waiving overdraft fees disrupts financial institutions' revenue streams, making it necessary to explore alternative solutions. 7. Transitioning towards liquidity management. To address these challenges and recover lost fee income, banks and credit unions must shift their focus from overdraft programs to comprehensive liquidity management programs. These programs should be proactive and personalized, offering speedy access, implementing de minimis exceptions, using tools to limit fees for low-income consumers, and providing a range of credit alternatives. In doing so, they can offer a more balanced solution that caters to both consumers' needs and financial institutions' sustainability, ultimately ensuring fair treatment and financial stability for all.